For any small business owner, understanding accounting principles is crucial for the health and longevity of the business. Effective accounting not only helps in compliance with legal regulations but also provides key insights into the financial performance and potential for growth. In the United States, several accounting principles are vital for proper financial management, tax compliance, and long-term success. These principles are governed by the Generally Accepted Accounting Principles, GAAP, a set of accounting rules that all businesses must adhere to for consistency, transparency, and accuracy in financial reporting. This video explores the top 10 U.S. accounting principles that every small business owner should be aware of to ensure financial success. 1. The Revenue Recognition Principle. The Revenue Recognition Principle dictates that businesses should only recognize revenue when it is earned, not when it is received. This means that if a product is sold or a service is provided, revenue is recognized at the point when the transaction is complete, even if the payment will be received later. This principle helps businesses accurately report their earnings and understand their financial standing. 2. The Matching Principle. The matching principle requires that expenses be recorded in the same period as the revenues they help generate. For instance, if you incur costs to manufacture goods that will be sold in the next quarter, those expenses should be recorded in the same period as the revenue from the sale of those goods. This ensures that the financial statements reflect a true and fair representation of the business's financial position. 3. The Cost Principle. According to the cost principle, businesses should record assets at their original cost, rather than their current market value. This principle ensures that financial statements reflect the historical cost of assets, which provides a stable and objective measure of the company's assets. For small businesses, this means recording your property, equipment, and inventory at the price paid for them, rather than their current resale value. 4. The Full Disclosure Principle. The Full Disclosure Principle states that businesses must provide all relevant financial information in their financial reports. This includes any information that could influence a user's decision-making, such as future liabilities, risks, and contingent liabilities. For small business owners, this means keeping transparent records that fully reflect the company's financial health and any potential challenges. 5. The Consistency Principle. The Consistency Principle asserts that businesses should use the same accounting methods and procedures from one period to the next. This consistency allows for comparability across financial statements, helping investors, tax authorities, and business owners better understand the company's financial trajectory. Small business owners should ensure that their accounting practices remain consistent year over year unless there is a legitimate reason for change. 6. The Conservatism Principle. The Conservatism Principle advises that businesses should record expenses and liabilities as soon as possible, but revenues only when they are certain. Essentially, this principle favors caution in financial reporting, ensuring that businesses do not overstate their financial position. For small business owners, this means erring on the side of caution when projecting profits and recognizing losses or expenses early on. 7. The Materiality Principle. The Materiality Principle allows small businesses to ignore minor accounting discrepancies as long as the impact on the financial statements is insignificant. For example, rounding errors or small purchases that do not materially affect the business's bottom line may not need to be recorded in detail. This principle enables businesses to focus on larger, more impactful transactions, without getting bogged down by trivial issues. 8. The Economic Entity Assumption. The economic entity assumption states that a business's financial transactions should be separate from those of its owners or other entities. For small business owners, this principle is critical for maintaining clear financial records. It ensures that personal expenses or income are not mixed with the business's financial statements, thereby providing a more accurate and unbiased view of the business's financial health. 9. The Going Concern Principle. The Going Concern Principle assumes that a business will continue to operate indefinitely unless there is evidence to the contrary. This principle is vital for businesses that need to secure loans, attract investors, or manage their long-term growth. Small business owners should understand that if their business faces financial difficulties or the likelihood of closure, it may need to disclose this in its financial reports. 10. The Time Period Principle. The time period principle establishes that financial statements should be prepared for specific time periods, such as a month, quarter, or year. These periods provide a clear picture of the business's financial performance over a set time frame, helping business owners make timely decisions based on up-to-date financial information. Small business owners should ensure that their financial reports reflect accurate periods to assess their business's financial health accurately. For small business owners, understanding the fundamental accounting principles is crucial for financial stability and success. By following the generally accepted accounting principles, GAAP, business owners can ensure consistency, transparency, and accuracy in their financial reporting, helping them make informed decisions, comply with tax regulations, and maintain healthy relationships with investors and stakeholders. Whether it's recognizing revenue at the right time, matching expenses with earnings, or ensuring full disclosure, adhering to these principles provides a strong foundation for managing a business's finances effectively. Small business owners should consider working with an experienced accountant to implement and adhere to these principles, ensuring that their financial statements reflect a true and fair view of their business's operations.